Hey everyone, this is Mark Treichel with another episode of With Flying Colors. I'm back with Steve, Todd, and Dennis. Guys, how you doing today?
Doing well.
Doing Steve, that nod's gonna come through good on YouTube, not so much on the on the podcast, but podcaster Steve's doing well. He's nodding, so all is good. We got Dennis hanging out in Arizona, and I asked him if he saw Kyler Murray on a plane to Minnesota. I was hoping I could announce that today's podcast is being recorded on the beginning of the Kyler Murray era, but not yet. But we're not here to talk about football. We're here to talk about the fourth quarter data, the fourth quarter reports that have come out from NCUA. This has gotten to be one that we do every quarter that is always kind of fun, where we look at what the numbers are showing, what the numbers are not showing. And guys, it's been a few months since you were on the show, so let's start with Steve. Short summary of your background in credit unions.
Background can be broken into three separate parts. The first part was in the field as a NCUA examiner and problem case officer for roughly 15 years. And in that, there's a lot of enjoyable work working with the credit unions and conservatorships and turnarounds. Then when you went to the central office, I followed you there and worked remotely in the Division of Risk Management and highly involved in the kind of the accounting for the NCUSIF, in the training of problem case officers, which was most enjoyable. And towards the end of that career, I ended up as the vice president of the CLF. So I did that. And then, we've been doing this for a while now, and post-retirement in the consulting. And part of what I did do a fairly short stint as a chief financial officer for a conservatorship, NCUA conservatorship in Manhattan. And then we've enjoyed what we've been doing to help the credit unions doing this for, we have almost 5 years.
I think we're into the 6th year of consulting, okay. Steve and I, and Todd, you're like right behind that. So let's pivot to Todd.
Well, I spent 34 years with NCUA. I can kind of break my career into three pieces like Steve's, where the first third of it, I was an examiner and a problem case officer in the Western region. Went through a few recessions then, so the PCO side of the career was very busy and active back then. For the first decade of 2000, I spent it as a capital market specialist in the Western region. Did a lot of teaching on capital market issues, occasionally would help Steve with a problem case class here and there. And then the last third of my career, from 2010 basically to 2021, when I retired, I was the director of special actions in the Western region, dealing with problem credit unions, supervising problem case officers, regional capital market specialists, regional lending specialists. Very enjoyable career. There was some things not fun when you had to close or liquidate a credit union. There was a lot of fun when you could actually see a credit union go from troubled status back to that CAMEL 3-2. Did a lot of conservatorships over my career. I did return 2 of them to the members, so that all is kind of a chip on my shoulder. Some people at NCUA, they keep souvenirs from credit unions that have failed. You won't find any failed credit union stuff in my house, but I do have stuff in my house from the credit unions that went into conservatorship and were returned to their members. All in all, a very enjoyable 34 years at NCUA. I enjoyed almost every bit of my career. Spent a lot of that working with Steve, the first third of it. I retired in June of 2021, and I don't know, it was late August, early September. Mark gave me a call, and I told my wife, yep, there's going to be a job offer here out of dinner tonight. And so I've been helping Mark since late 2021. So when we get into the late 2026, I'll hit the 5-year mark with you.
There you go. Yeah, that was a trip out to see Dave Matthews at the Gorge, I believe, and we made the pit stop.
Yeah.
Caught up with Steve and Todd and Dennis.
Yeah, I'm a short timer with Mark. I've been with Mark for about a little bit over a year now, but I spent 38 years in the credit union industry. Most of it was with a credit union, actually. 32 years at Ideal Credit Union in St. Paul, Minnesota. I was retired in September of 24 as their chief financial officer and executive vice president. But I started my career with NCUA back in 1986, and that's where Mark and I got to know each other. We started about the same time in Minnesota. traveled up and down the state of Minnesota, examining credit unions up on the Iron Range and all over. So we had a good time those 6 years. But that's where I started my career and got to know credit unions. So I had enjoyed my time with NCUA, but thoroughly enjoyed working as working at the credit union. I started when the credit union was about 100 million in assets, and I stayed there for 32 years. And when I left, we were about a 1.1 billion in assets, and that was mainly organic growth. We had a couple of small mergers during that time, so it was sort of neat to go through that time with that credit union. And I enjoy working with Mark here the last year. Sort of has kept me engaged in the credit union world, so I appreciate that.
Yeah, this is fun. This is a lot of fun. And I like these quarterly reports where you guys dive into the data and tell me what's kind of going on. So with that, what's going on? Where do you want to, what topic, what trend do you guys want to start with, and who wants to start?
Because these guys are like keeping their mouth shut, I'll open mine.
Okay.
Maybe just give a little background context about 2025. We've had a lot of volatile years with COVID, this massive influx of deposits from all the government assistance. Then we had this inflation. Freddie kind of had a hard time dealing with that. A lot of long-term investments underwater and stuff. 2024, last year, things kind of normalized. And I would say 2025 is a little bit more of normalization. Unemployment was fairly stable through most of 2025. There's some ups and downs in different states and a lot of variations in different states. The yield curve, well, it's still inverted at the short end. In general, most interest rates fell about 100 basis points throughout 2025. So it gave credit unions a chance to catch their breath and get caught back up on that net interest margin. Some other just interesting things that went on, and I think this will come out later on the podcast. Even though inflation is down, inflation is still faster than wage growth. So savings rates across the country have been dropping. They were just a little over 5% in the quarters at the end of 2024. But at the end of 2025, the national savings rate's down to 3.6%. People are being a little bit challenged. But all in all, 2025 was kind of a year let people catch their breath and still catch up from all those years of volatility and that whipsaw they got with COVID, inflation, and everything else.
Todd brought up interest rates, and that's the interest rates have come down, and it's interesting to see what's going on in the credit union's deposit portfolio, right? We saw a huge run up of CDs in 2023 and 2024. Well, that's beginning to shift a little bit as interest rates come down. There's not much of an advantage on that short-term end now as there was in the past. So you see that there's been a huge acceleration of CD growth, and a lot of that growth is now going into non-maturity deposits. Let me see, I had my notes here on growth. Yeah, for the year end 2025, let's see, share drafts were up 8.3%, and in 2024 that was at 2.93%. And the largest increase in deposits was in money markets this past year at 9.38%. And at the end of the year, 2024, that was 2.37. And CD growth, still fairly strong for 2024, was at 7% roughly. And in the year of 2024, it was around 14%. So you're starting to see that decelerate. And I think most of those CDs that are maturing are short-term CDs. So I think I read somewhere 80% of the CDs are going to be coming due in the next year, or going to be coming due here in 2026. I think the pricing will be key as to try to keep those margins up. So I think we're starting to see we started to see the cost of funds rate drop, but that's sort of slowing down. And also with the yield on assets as well, that's still up, but the growth of that increase has slowed. So I think we're probably at the top of the net interest margin, peak here in 2025. So be interesting to see next year, 2026, what type of pressures are put on that interest margin.
I'm going to throw another little piece out there. So NCUA, with their call reports, they also do a chart pack. There's like 42 graphs in there and they haven't going back for 10 years. But something that the industry has to think about is where do tomorrow's members come from? So while deposit growth last year was a little over 5%, and I always question these numbers because of how credit unions fill things in, and that's their membership numbers. But membership only grew 2% last year. It's the lowest level in probably a decade. And what does that mean for credit unions long term, or when you can't generate new membership growth, or membership growth is getting very low? Just
Yeah,
something
true.
for you to think about. Where is tomorrow's members going to come from?
Yeah, and I think that lower growth is the result of this increased competition that we keep talking about and hearing about. And so there is it's very competitive for bringing people in, and you always know that people don't tend to leave their primary financial institution until they become angry about something or feel mistreated. But they're real rate conscious, and it's easy to move money. And there's really great marketing out there done by a lot of these really institutions that you see that are on a lot of the advertising.
Well, and along those lines, when you say that, I'm thinking of the different generations and the makeup of credit unions and boomers who don't borrow but have a lot of deposits. And as you get younger, we've talked a little bit and may talk about a little bit more here about what it takes to get the younger people involved in credit unions. There is a podcast I did a couple months back with Dan Prezioso of Olden Lane. I'll link it in the show notes, but where we talked a lot about the different generational challenges that credit unions are facing. I think we talked about it maybe a little bit on the cruise that we did with the Q's cruise that we did as well, but specifically on any more on deposits or any more on growth that you guys want to chat about?
I said growth was pretty slow and balanced last year. Share growth was a little bit ahead of loan growth, so we did get to see a lot of credit unions that were paying back borrowed money. That helped their net interest margins again. But, all the growth numbers were in single digits last year. Maybe Steve will tell us about banks. He usually digs into the bank numbers when we do this podcast. But I actually believe the banks probably grew a little bit slower than credit unions did even. So they weren't growing very fast last year either.
Yeah, the community bank growth rate was pretty low for 25. It was basically 0.96%.
Wow.
And just up, down about half from what it was the year before. So the community banks are saying slower growth also. So
Interesting. So we kind of started with the discussion on deposits, which when I think deposits, I think you think growth, but you think liquidity. Let's go back to the beginning of the CAMEL. Let's talk about any capital trends that you highlighted when you reviewed this that you want to chat about.
One thing I know, when you look at net worth year over year, it's up from 11.2, I think, at the end of 24. It's sitting at 11.28. However, at the end of the third quarter, it was at 11.35. So we saw a slight downward movement in the net worth ratio. And that, we had a little, that might be a little bit smaller amount of earnings, right? So in effect, asset growth, even though it's been somewhat muted, 5% is not bad, but obviously equity growth didn't keep up with it in this last quarter. So I don't know if that's a trend or if that is just related to year end cleaning up some of the balance sheet. But I did notice that a little slight downward movement in the net worth ratio, which part of it might be related to ELL is a little bit elevated, right? They're sitting at 61 basis points, which is a little bit higher than average. So I think we'll probably talk about that in a bit, but that might be part of it. And then, and we talked about, I think this in our last podcast, we continue to see a trend upward in the non-interest expense. So that might be putting pressure a little bit on earnings, which then not making enough earnings to keep up with that asset growth causes that net worth ratio to slip a little bit.
On the positive side, there's only 59 credit unions that are not well capitalized in the whole U.S. So, you got that regulatory well capitalized number at 7%. There's only 59 credit unions out of 4,000 that are below that 7% ratio. So, well, NCUA has laid off 27% of their staff or 25% or whatever the number is. They haven't publicly disclosed how many people have actually left in the last year and a half. The credit unions are in good shape for the moment. NCUA can catch their breath a little bit. There is a lot of capital out there. Now, competitively, should capital ratios be higher? You can make an argument, maybe they should be higher, but overall, from a regulatory standpoint, credit unions are in pretty good shape right now in terms of capital. They're still recovering from those unrealized losses in those investment portfolios that go all the way back to the COVID years, but that's getting better too. Gap net worth, it went up almost 200 basis points in the last couple of years. So that's a positive there. Later on, we'll talk about some credit unions are trying to undo all the good that's come about with that, but we'll save that for later in the podcast. For the moment, though, as an industry, the credit union capital-wise are looking
very strong. Steve, any thoughts to throw in on capital before we pivot?
Yeah, if you compare capital back against the community banks who are sitting, they're very similar right now because their core capital ratio is 11.05. Theirs did increase, but you would expect that because they had slower asset growth.
Makes sense. So let's pivot to asset quality. And, Todd, you mentioned part of assets is the investments side of things. And I went back and kind of looked at what we chatted about last time. You talked a little bit about people going longer in the 3 to 5 year bucket, which, if my numbers look right, that investment category has gone up 17%. So let's start with that. People undoing the rates have gone down. They're recovering some of their gap equity, but they're starting to go long. And Todd, what do you got on that?
Well, like I said, the yield curve has come down, but it's basically flat. And then you sit here and look at COVID years, credit unions went long, banks went long too. Some of them failed because they went long on investments during this time period. A lot of credit unions did. So now they ended up with investment portfolios that are underwater for a long period of time. And they're illiquid. You can borrow against them, but they're basically illiquid. Well, now we're in a similar environment. So rates have come down a little bit. The yield curve is flat. And then dollars of investments in that over 5 years, over 10 years, over 3 years, every one of those categories, dollars grew. And there's like no spread between, going out from 3 years to 10 years. And you just wonder why they're making bets that rates are going to fall. What if rates don't fall? There's like 11 basis points between a 5 and a 7 year investment. And there's only like 14 basis points between the 3 and a 10 year investment. Why are you going out 10 years? That little bit of yield you gain is not worth putting that much interest rate risk on your books for a decade. It makes no sense to me.
The risk is high and the reward is low, is what I'm hearing you say.
I'm sure there's a whole bunch of investment brokers out there that will tell me. But I know I fixed a lot of problem credit unions in my career where they made mistakes just similar to this. And it just seems to not make sense to me. Now, maybe there's a credit union out there where their loan to share rate are always 20%, where they could maybe make an argument that some of it. But realistically, credit unions over $1 billion are 78% of the industry. So this is big credit unions making bets to make those dollars. This isn't little credit unions. This is big credit unions doing that. Maybe some of them will be our clients a couple of years down the road.
So there is that. Yeah, investments in going along. Dennis, Steve, anything you want to add to that before we pivot into the other asset categories?
No, and maybe this will segue into loan, but right, when you look at, if you're looking at, we're going longer in the investment portfolio, you look at where loan growth has occurred, and it's in mortgages and commercial. So it tend to be a little bit longer. So you're sort of doubling up there of extending your balance sheet duration. So
that's a good point.
Yeah.
Steve, anything on investments? Anything compared to banks?
I have nothing to add.
Nothing to add. All right, let's pivot into the other asset quality conundrums or positivities, whatever they might be. Loan delinquency. Dennis, you talked a little bit about charge-offs, talked a little bit about PLL. What are the numbers showing on loans, gentlemen?
Yeah, what I saw for like delinquency, that has crept up a bit, particularly if you look at real estate. I think that's where the biggest category where I saw an increase in delinquency. That was up 10 basis points from year end 2024. But it's interesting, right? I think at the end of 2024, delinquency rose quite a bit. And then in the first quarter of last year, it came down nicely, but now it's back up to where it was at the end of, or a little bit even beyond where it was in 2024. But it looked like it was real estate related. I don't know if Steve or if Todd saw anything different, but that's where I sort of saw where that delinquency really picked up.
I've got every category on the call report in a little chart right here.
All right.
All right, let's hear it.
And
Let's hear it.
just about everywhere. But I'm going to throw one other thing out there too, because this is kind of a red flag. So I mentioned NCUA has their little chart package that has a decade of numbers in it. This is the first time in a decade where delinquency for the whole industry has been over 1%. Which is
Nice drop. That's a big note. That's a powerful stat.
yes. So within the credit unions, what you see is so commercial loans have been growing. Delinquency in those commercial categories have went up pretty significantly, especially with the construction and development piece, the non-owner occupied commercial real estate. That delinquency jumped almost 25 basis points last year. Farm operating loans, which there's not a lot of in credit unions, their delinquency has really skyrocketed. Student loan delinquency has shot up. Most credit unions have non-government guaranteed student loans that have went up. Unsecured delinquency has actually stayed kind of stable. Car loans have stayed really stable. You would think that would be a troubled category, but we talk about loan growth. Auto loans actually shrank in the credit union industry. I don't know if I've ever seen that in my career where the dollars of auto loans actually didn't go up. Of course, new vehicles I just bought one here recently. They're a lot of money. I think people say there's trucks out there that are $100,000 now, which is kind of crazy. So a lot of the areas, the real estate delinquency has jumped up, primarily like primary residence. That hasn't moved much. It only went from 79 to 88 basis points. Real estate, second loans, those HELOCs, their delinquencies only went up 9 basis points. It's at about 0.89. This other residential real estate, though, kind of non-owner occupied, that shot up from 62 basis points to 141. That's not a big chunk of the real estate.
Right.
But they're not commercial loans, but they're 1 to 4 family dwellings or single things that are non-owner occupied.
Say those numbers again. 61 basis points to 141
points to 1.41. So you see these little segments of the industry, and prior to under the old business loan rule, those probably would have been called commercial loans,
right?
And they're not anymore. Some of that's probably undeveloped property too. It's just bare land is probably in that category somewhere too, but you just see things kind of wearing away at the edges. And I think it kind of goes back, I'm not going to throw out all the statistics, but you look at unemployment across the 50 states, you look at earnings in the chart map across the 50 states. There's a lot of places where there's huge disparities in performance. And you see this with the banks too, Steve. If you look at those regional levels, the numbers are very different from region to region. So we have parts of the U.S. that are doing really well and other parts that are not doing as well. And, I suspect if we actually pulled this at a state level or regional level, that you would find that a lot of these delinquency increases are probably isolated in a small number of places, maybe a quarter of the U.S., which is kind of interesting because you go back and look at our experiences dealing with troubled credit unions, and I'm sure he saw this, Mark, as a DSA, the PCO, and regional director. Recessions in places where performance deteriorate all tended to be regionalized at different times, and when I was a PCO, we had a time period, Montana and Alaska kind of sucked. And then they got better. And then it was Southern California where had issues. And then it was Northern California that had issues not related to Southern California. And And we had a period of time, we had issues in Hawaii. And then, of course, the last recession, the sand states, it was really 5 or 6 states that got hit really, really hard compared to the rest of the U.S. And I suspect you're getting some of that with the delinquency increases here. If we really dug into it, there's probably very much regional aspects to that underneath the national numbers.
Yeah, if we duck, and again, 1.41, 141 basis points is the average delinquency on that category. If we looked at the granular data going out 1, 2, 3 standard deviations, there's probably a handful of institutions that are materially impacting that number without getting into. I haven't looked at those numbers, but that would be an interesting deep dive.
Like I said, the credit unions over 1 billion, and there's 439 of them, and there's 21 in the ones credit unions that are over 10 billion. Those credit unions account for about 79% of the total credit unions assets. And when you see numbers like this jump, it's probably someone in one of those 2 categories, or maybe 4 or 5 credit unions in that category.
Yep.
In that 460 credit unions. It's probably just a handful of credit unions in that 460 that are actually moving some of those numbers. Because I noticed, like with our own clients, most of them, their delinquencies were pretty stable in 2025. They didn't move very much. So, we might have a client here and there that did see some delinquency rise. But for most of our clients that we deal with personally, their delinquency and charge-off numbers were really stable from 24 to 2025. But nationally, you're seeing some red flags out there.
Well, and I'm going to take this opportunity, since you brought up ones, to say, hey, NCUA, if you're listening, when are you going to tell the world that ones is or may be going away? You've told your staff, but you haven't technically told the stakeholders. Let's get on that as soon as you can. Maybe there's good reasons for not telling them. I can think of a couple that might be contemplated as potentially good reasons, but there really are no good reasons, because the world of credit union deserves to know. And while it only impacts a few of the large credit unions, that does trickle down. So, all right, I'll get off my soapbox on NCUA's needing to communicate better. Steve, any thoughts from a bank perspective or in general on this?
You can see the similarities they're having that in delinquency across the industry for community banks and credit is double what it was in 2022. So that's why people are really worried about it. But I always look more specifically as delinquency is an issue that we have to deal with in terms of collections and all that. But where it really becomes a problem is in losses. And, the loss ratio, I didn't know anything for a segment in our industry, but the credit union loss percentage is much higher than it is in the community banks. Their loss net charge-off for loans was 0.21 for 2025, and it stayed below 0.2 the last couple of years. And the credit union industry is 0.78. So that reflects in the provision for loan loss expense, and that's a little bit of a competitive disadvantage that the credit unions probably have. And Todd did notice that regionality is huge when you look at the community bank data, that their losses are just so much higher in that San Francisco region compared to every other region. It's just way out, almost out of bounds.
Interesting. Well, and some of that, if you were to talk to individual credit unions, if you're talking to low-income designated credit unions, or some of that higher delinquency and loss ratio specifically would be tied to theoretically serving people of modest means, right? In some instances, it's loan quality, but it's credit unions owned by the owners, so maybe they're making broader decisions on their loans potentially. But that gap it is more than what that would tend to.
I think that's part of it, Mark, to be honest with you. That is part of it. It's part of the tax exemption. You go back prior to the last recession in 2008, and my numbers are probably kind of foggy, but, I don't remember like 1% charge-off being something that bothered me back then.
Yeah, exactly. No,
And,
it's a great point. when numbers double, but the number was so low, and when those are not numbers that scare any of us is from a risk perspective, but it's the trend. It's more the trend and the velocity of the change, maybe.
Yeah, and like last year, that all the numbers were fairly stable with inflation. Interest rates came down a little bit. Now bonds are flying through the sky. That creates volatility and uncertainty. So who knows where things are going to go? Yeah. Like I said, there's always been this geographical differentiations, parts of the country doing really well, parts of the country not doing so well. I think that will probably always be there, and it'll be just interesting to see how that plays out. But I do think for NCUA, where they've had these cuts in staff, they're going to have to be paying attention to loan quality, loan quality, loan quality, loan quality, and concentration risk, because it's loan losses that cause losses to the insurance fund. And with their scarce resources, that's the one thing they absolutely need to be paying attention to, is asset quality in the trading industry.
And when they're done with that, they might want to look at asset quality. All right, let's pivot to, let's see, we did the C, we did the A, we sort of did the L. I think that leaves the E. We've talked about it a little bit. What are we seeing in the earnings arena, gentlemen?
Compared to 2024, ROA was up 16 basis points, very strong. Fueled by net interest margin, that was up 27 basis points. So, right, that contributed to the bottom line. If you compare it to Q3 2025, things are changing a bit. Actually, ROA is down roughly 3 basis points from 79 to 82. And as I mentioned, it seems like net interest margins possibly have peaked. That was only up 1 basis point if you compare year end to quarter 3 compared to 27. So, right, so that slowed down. PLL is roughly the same. Non-interest income is flat, not really any changes. And we still continue to see a little bit of an uptick in operating expenses. That was only up 2 basis points for the quarter, and it was up 10 basis year over year. So, right, I think so. So I think that acceleration of net interest margin is basically done, and that's depending upon how we manage, how credit unions manage that non-interest expense, and then loan quality will really determine ROA first part of this year. Be interesting to see what plays out.
Part of the whole net interest margin is, you talked about earlier, they've been whipsawed with inflation and deposits, this, that, rising interest rates falling. But like last year, they're still playing catch up because loan yields went up. They were able to bring cost of funds down a little bit. That's what helped that net interest margin. Is they're still playing catch up on those loan yields. Investment yields were up a little bit too. But the last thing that Dennis mentioned, the operating expenses, that's a challenging one. So we've got 1, 2, 3, almost 4 years where operating expense numbers relative to assets have increased. And yes, there's been some massive inflation in there. Yeah. But we've also had some years where there's been a fair amount of growth in there too. Well, actually, not really. Asset growth 5, 4, 2, 5. That operating expense number going up though it would make me nervous if I was still working at NCUA.
And it's been at least 6% for 3 straight years, the operating expenses, which I wonder when the last time that happened was.
Yeah, I think a lot of it's related to wage inflation. We talked maybe a little bit about this in the last podcast, but right, the last 2 years, 2024 and 2025, salaries and benefits went up roughly 8% each year, whereas asset growth has been a lot lower than that. So that's going to push up, right? That's just going to push that ratio up. But 8%, right? That I didn't go back to years prior to that to see if that seemed a little bit high compared to historical numbers. But right, I think it's a little bit of a catch up because of inflation that went on from 2021 to 2023, trying to maintain and retain staff. So that might be a big piece of it. It's nice to see that it's starting to slow down the rate of operating expense growth. Hopefully that's peaked. But that was a contributing factor to that, obviously, to the increase in overall operating expenses.
That kind of led the way in 2024, but I actually just brought up that whole income statement for 2025 in front of me. It's virtually every category went up 8%.
Yeah.
In fact, your employee compensation and benefits only went up 11.2. It was one of the growing ones. Dollar-wise, it was a big one because dollar-wise, it's what, a third of almost 50% of the total expenses. Operating expenses is almost half of it is employee compensation. So that half went up 7% and the other half went up. Most categories went up close to 8% last year too. So it's a little bit of everything. But yes, wages and compensation, as Dennis brought up, that's half of operating expenses. So it's a big number. And it's hard to control that when inflation is growing, but if we go back and just look at staffing for members, I'm sure I have that here in my notes somewhere. I do. Members to full-time employees has stayed relatively stable. Actually went down a little bit in 2020.
Yeah, so you could go back to with the other expenses. Mark, you were talking about membership growth and credit unions staying relevant. So, right, part of the challenges in this digital world is to invest in your infrastructure, your AI, your digital presence. So that might be fueling some of the additional expense growth in operating expenses. Is that strategy or that of staying relevant so that we can grow their membership? I think is maybe a piece of it as well.
I think you're probably right, Dennis, because I suspect during the COVID years, a lot of that type of stuff didn't occur.
Yeah.
So people were playing catch up here in the year since. It's interesting how we're 3 years out of that, and you still see that event having an impact on what's going on across society in many ways here.
Many ways, for sure.
Well, that 7% expense growth rate is basically what they have had in the community banks, or the credit unions are actually below the community banks in the rate of growth. An interesting thing that we had that when NCUA had the podcast on, what was it, Todd? Where I submitted the question, which podcast was it or webcast NCUA did?
Their supervisory priorities.
Yeah. And I'd submitted the question as, what's NCUA's thought on a credit union putting their capital to work in terms of raising expenses as they try to increase technology and increase in the competition? They read the question, but the answer had nothing to do with the question that I'd asked, because I wanted to try and get them more, on the record is where do they stand on credit unions trying to put their capital to work to address the competition that they're facing or even other issues that they have.
Well, and sometimes, having been in on those webinars, it's a little bit like, it can, when you're on the other side with NCUA, it's a little bit like making sure planes don't collide, and you've got, okay, this question, we want to make sure we answer it, and who are we going to assign it to? And you got people that one's for me. And I'm guessing what happened, Steve, is someone said, hey, this is a good question. Why don't we have this person answer it? I got to go back and listen to it, but there was a mismatch between what they thought the question was and maybe the right person wasn't in the room.
Yeah, but we can throw it out to, Todd and them as we're hearing it from our clients is really, we're trying to address the competition issues, but they're not feeling support from their NCUA examiner.
I mean, we've got credit unions that are way, way north of 7%, and, they're getting doors about earning, they're getting doors about, hey, we think you need more capital. Of course, they can't define what that number is. And this is, the one client that we had it's a very diversified client. They have no concentration risk or anything, and they're still getting flack from NCUA about putting some of their capital to work. And we have another client that just got a door. It says, you may have too much liquidity risk. Not you have too much, you may have some. And, so it's kind of a nebulous thing. And, Steve texted me that capital question the day before, and I said, oh, they're not going to read that question. So they read it, but they didn't answer it. They didn't even read my question. So I can't remember what I sent in, but I always send one in just to see if they'll read it or not, because, they can see your email that you register with. So they know who's asking these questions for the most part.
I don't ask questions. I figure they'll
You just need to come up with like a Mickey Mouse email or something.
right.
Yeah. I don't know who you are.
But,
I guess, right. But we also got to look at expenses in relation to the income. So the efficiency ratio, right? So those look pretty stable. They've actually continued to drop, partly because that net interest margin bumped up. But so I guess you'd be concerned if you saw operating expenses increasing and then also the efficiency ratio increasing, but we're not necessarily seeing that. So that's one thing I looked at a lot at our credit unions, just kind of income are we generating to be able to support those expenses? And overall, it looks like credit unions have done that quite nicely this past year.
Yeah. The efficiency ratio hasn't actually moved at all. I mean, it moved a little bit.
Yeah, it came to, I show that it was at about 72% at the end of last year, and it's down to about 69, 70%. So it moved a little bit, didn't go up. So that's what I'm trying to say.
Yep.
Yeah, and in the end, we had 11.7% of credit unions are unprofitable. And
Only 5% of banks are unprofitable.
5% of banks. Yeah.
So I actually, if that's another one that NCUA gives you a little 10-year history on, or no, I did a query on it myself. We have 100 credit unions over 100 million exactly that were negative earners in 2025. There was 500 credit unions lost money, but there was 100 over 100 million that lost money. And I thought that was kind of a interesting number. So you've got some large 17 credit unions over $1 billion lost money. That's 5% of them. So that's like in line with the community banks, but 11% of the industry losing money, that's a fairly big number.
and those small ones that are losing, that's probably where a lot of the mergers are. I was looking at merger data for some separate stuff, but every year, 4 to 5% of them are going away. And so if 11% are losing money, a lot of that 4 to 5% that goes away are coming from that 11%, especially when you look at the reasons they say why they're going away. All right. So earnings, any more things on the earnings topic? No. All right. So anything you got on your notes that you wanted to talk about that we haven't hit?
I usually give just a quick update on both the insurance funds, and they both did really good here in the end of the quarter. NCUA's equity ratio increased, and the bank one increased, and so they're both looking really good as far as the insurance funds, and so that's always good news.
Very good. And Todd, any last words?
Couple ALM things, net long-term assets in the credit union industry. They're going down just a few basis points every year. So there's no indication that interest rate risk is going up. It's actually staying stable or going down a little bit. And then last year, liquidity improved quite a bit. A lot of your wholesale funding was repaid. So credit unions have more capacity to borrow money and bring in non-member funds if they need to. So that side of things look pretty decent as well. So small improvement in liquidity. Interest rate risk wasn't going up. I'm an NCUA person. I'm only going to be worried about credit risk for the most part.
Asset quality.
And CAMEL ratings, it showed improvement. Especially in terms of dollars, it wasn't a big improvement like the reduction in CAMEL 3s, but there was 155 billion reduction in assets, which means there may have been somebody who was pretty big that is no longer a 3.
That'll cover some of their staff reductions and not having to go to do follow-up so much. Dennis?
The only thing I wanted to point out is the allowance coverage of delinquency. We'll look more back on asset quality, right? So that's how much do we have an allowance compared to delinquency? So at the end of third quarter of 2025, that was 140%. So a lot more coverage in allowance than in delinquency. That dropped to 131% at the end of the year. So that just says that the delinquency is going up, but the allowance isn't keeping pace. So really interesting to see how that transpires in this current year. A lot of it depends on where that delinquency is happening. A lot of it was happening in the real estate portfolio, so maybe that's fine. But it was notable though that it was at 140% coverage at the end of Q3. It's only 131% at the end of this year, and at the end of last year, it was 136%. So downward trend. So CECL, right? So CECL comes into play. See what kind of impact that might have for provision in 2020 and 2026.
And that number in the community banks is 153%. They've always had a bit more in their allowance than the credit union industry.
And
Do you have
Steve,
any trends from them, Steve, or is that just a point in time?
I just looked at this specific point in time, and it's been pretty consistent at that level.
The other thing though too is when you got delinquency reporting, the banks they have 30 to 90, and then NCUA has got 0 to 60, and then over 60. So the delinquency numbers aren't exactly the same.
Yeah.
and when I hear coverage ratio, I think of a meeting I was in with Steve Farrar and Dan Murphy, the former regional director, when Steve and I worked for him on the West Coast. And he said, when you guys come in here and brief me, you say, this one's doing bad, this one's doing good. I want to believe you, but I just look at the ratio of their delinquency to their allowance. And so we coined that the Murphy ratio back before we knew it was the coverage. It might have been called the coverage ratio back then, but we had it. That was the Murphy ratio. So I always think, so the Murphy ratio is not as good as it was. It's trending in the wrong way. That's something we can watch going forward. All right, guys, this was fun. I've got a Costco delivery coming in 2 minutes. So this worked out perfectly. Hopefully we'll get this uploaded by Tuesday for Tuesday's episode. Hopefully by then I've got myself a new quarterback for the Minnesota Vikings.
Good luck.
Yeah. Which Todd, by the way, if we get Kyler Murray, he was picked first. The Bears quarterback was picked first. The Lions quarterback was picked first, but not the Packers. All right, that's all I got.
They've developed theirs in-house, and they don't need a quarterback.
You're the quarterback farm. You guys always develop them. That's right. Yeah, good comeback. All right. Asset quality, and develop your quarterbacks from within.
Great bait. Find a defense.
Hey, you just signed a guy we cut, so he'll be good for you, though. All right, guys. Listeners, thanks for listening. Watchers, thanks for watching. Guys, thanks for your wisdom. And this is Mark Treichel signing off with flying colors.